You know, in a lot of my previous episodes, I've brought up options trading and how you can use it as a hedge, but also how it's a derivative and it can be extremely dangerous. I've just flirted around the topic of options. Today's episode, I want to dig a little deeper and tell you exactly what options trading is and how you could use it to potentially make a lot of money. Let's get into it. So first off, what are options? Well, an option is a contract that gives the bearer the rights to either buy or sell some underlying asset at a predetermined price, either at or before the contract's expiration. So basically, in layman's terms, if you bought a contract, you now have the option to either buy or sell a particular asset like a stock or a bond at a particular price by a particular date. An even easier to understand example is that I make you a particular bet or deal. I say, hey, I bet you $200 that Apple stock is going to go up by 25% within the next 6 months. So if you think that Apple stock is going to go up that much by that particular day, then you would accept my offer to buy that option. Meaning you would give me $200 for the option to buy my shares of Apple stock at today's price in the future. So if Apple stock went up 30, 40, or even 50% within that time frame, because of this contract, you have the option to buy my shares at the previous price, guaranteeing yourself a profit if it goes up. What I just described to you was a call option. You thinking the price of this particular asset or stock is going to go up by a set amount in a set period of time. So let's talk about if you were wrong. What happens to an option contract if you're wrong about the direction of the market? Well, in this case, let's say you accepted my deal, you paid me the $200, and instead of Apple stock going up, it actually goes down. Well, the good thing about options is that it is an option to buy, not a mandate. You have no obligation to exercise that contract, meaning you don't have any obligation to actually buy those shares from me at that set price. So instead of guaranteeing a loss and being forced to buy those shares from me regardless of market conditions, so instead you just lose that $200 you paid to me to have the option to purchase it. Now you might be thinking to yourself, that's super confusing and you're really risking a lot there. And the truth is that you are risking a good amount of money because options do expire worthless. But if you know what you're doing when it comes to options and do your research, you could actually make a large amount of money. And this is because option contracts leverage 100 shares in every single contract. So think back to that Apple option I just told you about a minute ago. You paying me $200 for this single option, meaning that you're only paying $200 for the option to buy 100 shares of Apple stock at that given time. So if you can get into the option at the right price and accurately predict which way this company is going to go, whether up or down, you can stand to make a lot of money using options in your investment strategy. Now, as I've mentioned in previous videos, options are just a smaller subsect of a larger group of investments called derivatives. And basically the price of a derivative is dependent upon the price of something else, some underlying asset. So think about it yourself. The price of these options or any derivative is dependent upon the price of something else. So let's just say that Apple stock was $20 per share. And I was offering you a deal that said if by next month the price of Apple stock was going to be $21 per share, then you know that the likelihood of that happening is great. So that fee that you have to pay to take that option or to enter that contract is going to be a lot higher than, let's say, if the price of Apple was only $5 per share and I said by next month it was going to be $21 per share. Basically, what you need to know about derivatives and options is that the price of that option, the price to get into that contract, depends on how likely that contract is to actually happen. Now, when it comes to options, there's really only two main options, and that is the call and the put. And basically, a call option is you thinking that the price of the underlying asset, in this example, Apple stock, is going to go up. And a put option is the exact opposite. You think the price of the underlying asset is going to go down. Now, the example I gave you earlier was an example of a call option. And in that example, the price of the asset went up. So you exercise your right to buy 100 shares of that asset at the lower price that was agreed upon when that contract was established. A put option is literally the exact opposite, giving you the right to sell an asset at a pre-designated price because you are assuming that the price is going to fall even further. Now, it goes without saying, options contracts can be extremely dangerous because one, these contracts expire worthless. So if you don't exercise these contracts in time, even if you're right and the asset has either increased or decreased in your favor, if you don't exercise these contracts in time, they will still expire worthless. And the second part is that you have to have the available funds and liquidity to buy and exercise that contract when you want to. There's no good trying to exercise a contract that's valued at $1 million if you don't have the funds to buy the 100 shares of Apple at the predetermined price to begin with. Now, I'm gonna make a separate video on detailed strategies that certain people use options with and how to make money. But in this video, I just wanna cover the two main ones. The first one is people using calls to leverage more shares of that asset to gain that much more equity and that much more growth more quickly. So let's say you only had about $200 to invest. You can use that to buy Apple stock and get about 1.25 shares for that $200. Now, the good thing is you now own that 1.25 share, and regardless of where the market goes, you will always own that 1.25 share. But the bad news is when Apple stock goes up, you're only going to see growth on 1.25 shares. So it's extremely slow growth. If you were an aggressive investor and were willing to risk losing that full $200, you can instead open up a call options contract on Apple and then find one that will give you this option for $200. You give the seller of this contract $200, and now you're successfully leveraging 100 shares for this contract. So as the price goes up or down in your favor, you're leveraging 100 shares versus that 1.25 share that you could have bought. Now, I know I just said you would have to have the liquidity to exercise this contract. Let's just say the option for this contract goes up so well that this contract is now worth $400. You could resell that contract to somebody else that has the liquidity to actually exercise it for that $400. So you got your $200 back from your option contract with an additional $200 because of the growth and likelihood that this option was going to happen. What you just did was purchase a call option from somebody and then sell that option to somebody else that had more liquidity and more money to actually exercise that option. And all you did was pocket the difference in fees. You made your money back plus some, and now you have $400 to invest. That is the power of leveraging option contracts in your favor. The other half is the put options. And people use put options to short the market and give insurance on their stocks. Let's just say you already owned shares of Apple, but for some reason they were going to tank. And you didn't want to just accept the fact that you're going to lose massive amounts of portfolio value. What can you do? You can use put option contracts as an insurance policy on your portfolio. If you had a feeling the value of your portfolio was going to go down, then you can open up put contracts. And remember, put contracts get more valuable or earn more money as the underlying asset goes down. So even though your portfolio value is going to go down with the market, your put options value is going to go up as that market goes down, thus providing a hedge or an insurance policy on your portfolio value. Because if the value of your portfolio went down $2,000, but your put options went up $2,000, you still have the exact same amount of money you had to begin with. And when you trade or sell that put option to somebody else, you can then use that extra $2,000 you have in cash to buy back into your market that you're already invested in, but now it's much cheaper and on sale, and you can successfully buy the dip. Those are the two main ways people use option contracts. One, either to fast track their growth or as an insurance policy on stocks and shares they already own. I hope you got value from this video. If you did, please remember to like and subscribe because it really helps this channel get out there and grow. I have a dedicated Facebook and Instagram account. I don't post there too often, but if you ever had a question, comment, or wanted something addressed, it's a lot easier to message me there and keep track of conversations than tagging and linking everybody here in the comment feed. Either way though, the choice is yours, and I'll see you in the next episode.